Welcome to The Explainer. Today, we're diving deep into the actual fabric of our modern economy, the unseen forces that are quietly shaping your everyday financial life. We're going to connect the dots from the abstract, almost philosophical idea of what money actually is, all the way down to why the prices at your local grocery store seem to be climbing totally out of control. It is a massive, complicated system, for sure, but when we break it down, the pieces really start to make perfect sense. Here's our roadmap for today. We're going to cover 1. The psychology of money, 2. The great wealth divide, 3. Profiting from poverty, and finally, number 4, why your grocery prices are so high. All right, let's jump right into section 1, the psychology of money, belief and trust. So, to really grasp our modern economy, we've got to realize it's all built on a massive collective psychological invention. It's belief. It's not physics. It's not biology. Think about it. Thousands of years ago, humans traded things that had actual intrinsic utility, right? Like cattle or salt. But cows spoil, and honestly, they're incredibly hard to carry around in your wallet. So we moved to a shiny metal formed in exploding stars, gold. It was durable, divisible, and, well, pretty. But eventually, carrying heavy sacks of gold became tedious and kind of dangerous. So banks started issuing paper IOUs that were backed by that gold. By the early 1900s, this whole system was formalized into the gold standard. But during major crises like the Great Depression, pegging currency to a finite piece of metal really restricted the government's ability to act. So, between 1933 and 1971, the U.S. completely severed the dollar's tie to gold, and we entered an entirely new era. And that brings us to fiat money. Since that gold window officially slammed shut in 1971, our entire financial reality has relied purely on trust in the system. The dollar in your pocket has value simply because you, me, and the global economy believe it does, and because we trust the central bank, the Federal Reserve, to manage it. But you have to ask yourself, what happens when the rules of that trust-based system start working very differently for different people? Which leads us perfectly into section 2, the great wealth divide, and the shift from shared to unequal growth. Now that we've got a handle on how money works in theory, let's look at the reality of how it's actually distributed in this modern fiat system. For decades after World War II, the American dream was thriving because shared prosperity was a mathematical reality. Back in the 1950s and 60s, as the economy grew and workers became more productive, wages for all income groups grew right alongside it. It was like a rising tide lifting all boats. But right around the 1980s, the rules of the game shifted dramatically. Worker productivity continued to soar upwards, but the average worker's wages, they just completely flatlined. So where did all that extra productivity and economic growth actually go? Well, it went straight up to the very top. As average wages stagnated, the individuals at the absolute peak captured nearly all of the economic growth. To put that into perspective, back in the 1970s, a typical CEO made about 26 times more than their average worker. But by the late 1990s, that gap skyrocketed to nearly 400 times. The rungs of the economic ladder were literally being pulled further and further apart. Let's put this into perspective and look at the daily, tangible reality of this divide. On one side, you have someone earning $25,000 a year. They're spending over 40% of their income just to cover rent. They're relying on an aging car where a single breakdown is an absolute catastrophe, and they have zero emergency savings. It's a brutal daily stress trap. Now contrast that with an elite earner making $25 million a year. For them, dropping $28,000 to replace their front teeth with veneers feels mathematically equivalent to a $28 expense for our lower income earner. It's wild. They charter private jets for $27,000 without even blinking, while their massive wealth continuously compounds in the stock market, entirely shielding them from normal, everyday financial consequences. Moving on to section 3, profiting from poverty and the welfare business. This brings us to a slightly darker corner of the economy. We're looking at the roughly $1 trillion taxpayer dollars spent annually that are actually intended to help those struggling at the bottom of this divide. Now, policies introduced in the 1980s and 90s fundamentally changed our welfare system. The idea back then was that the government was just too inefficient, so they outsourced welfare administration to the free market. Today, taxpayer money goes to the federal government, which passes it to the state, which then turns around and hires for-profit corporate middlemen to manage those benefits. The logic was to cut government waste, but it totally changed the pipeline of where your tax dollars actually end up. Because here's the thing, these corporate middlemen have a serious incentive to maximize their own profits, which sometimes means finding loopholes and exploiting the very people they're being paid to help. The source material outlines some staggering examples of this.
We're talking about tax prep companies luring in low-income earners just to secretly skim their tax refunds. Landlords jacking up rent way above market rates because they know government housing vouchers will blindly cover that inflated cost. Medicaid-specific dental clinics performing medically unnecessary root canals on toddlers just so they can bill the system. And for-profit dialysis centers actively avoiding referring their patients for kidney transplants simply because an empty chair means they lose a paying customer.
But honestly, perhaps the most shocking incentive in the data is how the most vulnerable kids in society are treated as a literal revenue stream. The source data reveals that states hire corporate contractors to scour databases for foster children who qualify for federal survivor or disability benefits. We're talking about roughly $700 a month, meant to supplement incredibly difficult lives. When the contractor successfully diverts that money away from the child and directly into state coffers, they get paid a bounty of $1,600 per child. It's a truly striking example of how profit motives can profoundly distort a system that was originally meant for care.
All right, Section 4, grocery prices, beyond supply chains.
Okay, we've looked at the abstract theory of money, the wealth gap, and the safety net. Now let's talk about your pantry. When you see grocery prices going through the roof, the story we always hear blames supply chain shocks. And look, it is completely true that events like droughts affecting olive oil in the Mediterranean or conflicts disrupting wheat and fertilizer in Ukraine severely mess up supply chains and raise costs. But the financial data reveals that is really only half the story. Take eggs, right? We've all seen those little signs at the supermarket apologizing for the sky-high egg prices, blaming the bird flu for wiping out flocks. But if we look a little closer at the financial data of the companies producing those eggs, it tells a surprisingly different tale. We have to ask, were those record prices really just the inevitable result of the avian flu? The reality is absolutely stunning. Cal-Maine Foods, which is the largest egg producer in the U.S., saw their profits literally explode during the exact height of the crisis. In 2023, they paid out $250 million to their shareholders. That is a massive 40 times increase from the previous year. And in early 2024, profits spiked 342%. Their stocks soared because they didn't just raise prices to cover their increased costs. Actually, they raised prices far beyond what was needed, significantly padding their bottom line while everyday consumers took the hit. You might be wondering, how do they get away with this? The answer is extreme consolidation in our food system. Take the U.S. beef processing industry, for instance. Just 4 huge firms control 85% of the market. This kind of intense consolidation completely removes real competition. So instead of competing to offer you the lowest price, these massive firms have the power to essentially just dictate what you pay. It turns out a lot of what we perceive as uncontrollable inflation is actually driven by corporate entities maximizing their profit margins right in the middle of global crises. They're using highly publicized supply chain shocks as a smokescreen to pass on aggressive price hikes to the consumer, effectively turning public panic into record-breaking corporate profit. So what's the big takeaway from all this? The overarching realization here is that this vast, unequal system we've just mapped out, it's not a law of physics. It isn't a broken machine. It is functioning exactly as it was designed to work by the people who wrote the policies over the last few decades. The flat wages, the poverty traps, the corporate windfalls. These are the direct results of choices, incentives, and rules. Leaving you with this final thought today, since humans invented this entire system of belief and commerce, from the first days of trading cows to fiat paper money to the complex supply chains feeding us today, we also have the collective power to change it. The economy is really just a story we all agree on. So what rules will we choose to rewrite next? Thanks so much for joining me for this explainer. Keep questioning the systems around you, and I'll see you next time.